You're listening to Knowledge at Wharton on Business Radio. Here again is Dan Loney.
Welcome back to hour number 2 of the Future Ready Conference hosted by the Conference Board in New York City. Coming up in this hour, you'll hear the panel that I moderated at the conference discussing with 4 executives why Future Ready is critical to business success. I'm joined by Claire Mason, founder and CEO of Man Bites Dog, Byron Boston, president and CEO of Dynex Capital, Christina Von Tassel, who is CFO of Dow Jones, and Arlene Isaacs-Lowe, president of the Moody's Foundation. But first, we're going to have an in-depth conversation with Claire Mason about what it means to be a future-ready organization. Part of this conference deals with some of the potential pitfalls that lie ahead if your company is not future-ready. Claire Mason is the founder and CEO of Man Bites Dog, a global thought leadership consultancy based in the United Kingdom that focuses on turning intelligence capital into a competitive advantage. Nice to meet you. Thank you. Man Bites Dog, where did the name come from?
Well, actually, the name hails from New York. What it means is it's the definition of news. Dog bites man happens all the time. Man bites dog's the story. It's an idea that's remarkable, memorable, and worth sharing. And that, in a nutshell, is what Man Bites Dog does. We produce big ideas that position our clients as global thought leaders.
So how does the want of a company to be future ready play into what you have to do with your firm?
I think what's really interesting these days is that investors actually don't look at your annual report filings in the same way they used to. They're looking for evidence that decodes the fact that you're future ready and that you're visionary. And what they actually look at for that is the thinking you share. So the content that you put out about how you see the future of your industry and what your vision is. And that's what investors are actually doing to decode your future readiness as an investment prospect. But it's also about what your clients are using to decide whether or not they want to work with you, particularly for companies in the business of selling brain power, so companies in professional services or tech or financial services. They're actually being assessed on the basis of their knowledge and their big thinking. And so that's why we exist, to help companies position themselves as future ready.
But the idea of being future ready is probably something that it's not new, but it seems like there is an increasing focus on it, maybe in the last few years, correct?
I think so. I think it comes back to that cliche of disruption, which is, the word we hear too often these days. But I think these forces mean that companies are having to think about much more fundamental changes than they'd ever considered before. So in our research, CEOs were telling us that actually their concerns about the future aren't about the economic cycle. They're actually structural concerns about whether they can get any more growth from their existing business model, right, and if they really need to transform to capture that next level growth. So I think there's a much greater focus on the future and future readiness because of that need.
But the understanding, though, for many companies, especially publicly traded companies, is that this is something that will impact bottom line. No question about it. And in order to be able to have that future-ready success that a lot of companies are looking for, there's an element of the quarter-to-quarter benefits that need to play in.
Yeah, and this is some of the research that we're going to be sharing at this conference is actually looking at this tension, this battle between long and short-term thinking, and which side of this battle investors and leaders are on. Because I think CEOs have a perception that investors will not back them on the journey to transform their companies. Right. But actually investors are more open to this than they think. I had a fascinating conversation with a CEO who described this challenge that they face to get future ready as the desert of no return. So the idea that every organization has to cross a journey from the old world to the new, and they've got to go through this desert where they have to reduce returns to shareholders or even burn capital for a period of time to transform their companies to be ready for the future. And the concern is that with a quarter-to-quarter reporting cycle, it's not possible for leaders to actually do the drastic sort of recreation of their businesses that is required for some of our traditional, most established companies to transform.
So is the future-ready mindset something that is relatively a new concept for the investor?
I think this is a very new concept. I think there's been a very big focus on self-disruptive leadership and CEOs needing to lead the charge. But if they're going to cross the desert, they need supplies, they need finance, and they need time. So now what we really need is future-ready investors. And I think what's going to be really interesting is looking at whether the investors are willing to provide that patient capital to help our organisations transform so that they survive in the long term. And I think it's quite interesting to question whether leaders like Elon Musk are right when he considered that, perhaps being publicly listed isn't the best place for a future-ready company that wants to, really grow and change. And although Tesla remained public, actually there's a huge growth in alternative finance, which suggests that a lot of leaders agree with him that actually there may be another solution.
And I think there are companies, especially this year, with all of the IPOs that we are seeing on the markets, there are some companies that are taking a second look at that decision to go public.
Absolutely. But on the other hand, we are seeing what investors were telling us is that actually for the right opportunity and with an appropriate valuation, they actually are willing to back companies over the long term. And it's interesting to notice that you do have these business models like Amazon where they're focusing on long-term stock value growth rather than quarterly earnings, and investors are willing to back them. So are leaders just making an excuse that the markets won't let them think long term? How do we kind of align the interests of these CEOs and the investors for the good of our, of the companies that all our pension funds are invested in?
Are there times though that you see, even though that you want to build that long-term thought process, that long-term growth, that there are situations where a balance between short-term and long-term still can be a benefit to a company and to an investor?
I think that a leader always has to keep their eye on the short term at the same time as looking at the long term. But I think for the level of fundamental business transformation we're looking at almost the creative destruction of business models. We're looking at companies pivoting into different industries. We're looking at a fundamentally different way of creating value. And so I think for some of our largest companies, they're going to have to make some tough choices about actually sacrificing in the short term for that long-term gain.
In your presentation, you talk about the fact that there's a distinct possibility that a lot of companies that are doing business now may not even be here in 5 to 6 years' time.
We interviewed 1,500 CEOs of the world's largest companies, and they told me two things, which for me was like the corporate equivalent of the icebergs melting. And it was firstly that they expect 1 in 5 of the world's largest companies to fail in the next 5 years. And the second thing, which was even more concerning, is that the majority of CEOs think their own company's past is brighter than its future. And these guys and girls are in charge. So the fact that they've got no faith in their ability to make this journey is very worrying. And the problem with why they can't cross this desert of no return, why they can't sort of make this journey, is this tension between CEOs and investors not aligning their interests.
So when you say that many of these companies are not going to exist, I would imagine some of them are companies that are going to be closing up shop, but some of them are also going to be potential targets for M&A as well.
Absolutely. But I think the fact that CEOs don't see a bright future for these very established companies that have a great track record and fantastic human capital resources of people in them, I think that is very worrying. And I think we need to look at investor behaviour. And I wonder whether actually there is a competitive advantage for patient capital for some of the major investment firms that we see that are willing to be patient, may actually get better investments. And that may actually help equalise some of the behaviour we see with short trading and things like that.
What do you think are the most important components then for a CEO today so that they can be someone that is future ready, that is able to take their company to the next step, that can truly find that level of success that their company is going to need, so they aren't one of those companies that is no longer here in 2025?
Well, actually, we did some fascinating work with Korn Ferry's leadership consultants and created a program called the Self-Disruptive Leader. And they have 150,000 anonymized profiles of CEOs. And we looked at how should CEOs behave with this level of uncertainty and the need not for command and control, but the need to really bring people with them? And I think they have quite different qualities, these self-disruptive leaders. They're willing to make changes before there's a burning platform, make quick judgments, test and learn. And they really are able to give people purpose and really energize people. And that's critical when your workforce may only work for you for 2 or 3 years. To actually align the purpose is absolutely critical.
And that brings up one of the other problems that you have in a lot of companies today is the fact that there is so much turnover. And because of that, the future-ready company may look a lot differently from a personnel standpoint in 5 years than it was a couple of years before.
Well, absolutely. And when we look at, say, the human resources function, that function is not in charge of your employees. It's in charge of all of the people that help you deliver what you do. And a lot of those people will be gig economy workers, and they'll be suppliers and contractors. So a large amount of the competitive advantage in your organization is actually outsourced talent or informal talent. So in terms of what the organization looks like and how you're going to win in the future, engaging all of your workers, not just your employees, but those people who are slightly at a distance for the organisation, is going to become critical too.
What do you think then are probably some of the biggest barriers that are out there for a company to try and make that adjustment, take that mindset, and truly make it thinking future ready?
I think that it has to come from the top. I think that leaders have to be willing to take risks and risk their own position and their own remuneration to do so. Yeah. I think that they need the backing of patient capital, and all capital is not created equal, and finding the right capital to match their ambitions. And I think we all need to be able to think quite creatively about the future, because even when a CEO's succession planning, she's not thinking how to fill her role today. She's thinking about what that role might look like in 10 years' time. Yeah. So I think that idea of future casting and working backwards and really doing very out there scenario planning for organisations will become much more important, because we don't yet know, will we be 100% gig economy companies, for example? Right. We don't know the extent of technology's impact on organisations and even on humans. We might have enhanced humans with technology, in the future. It's already happening. So, some really interesting trends to be aware of, I think.
Claire Mason is the founder and CEO of Man Bites Dog. You're listening to Knowledge at Wharton here on Sirius XM 132 Business Radio, powered by the Wharton School. How much then of the CEO having that mindset also, to a degree, has to filter down through the entire organization? We've talked numerous times on the show about how important it is to get a total buy-in from the entire company. So to a degree, you have to have everybody in your organization thinking future ready as well.
Absolutely. And one of the really interesting things about developing a self-disruptive leader is that the organization has become really good at filtering these people out. So the sorts of people that are going to be self-disruptive leaders probably didn't make it to the top of a larger corporate. They probably decided that they wanted to go and set up their own business, for example. And so at every level of the organization, we are probably filtering out some of our most visionary and most disruptive forces, because they struggle to exist in that kind of corporate framework. So I think you need to have a leadership program and succession planning at every level of the organization. And we need to be developing a whole new competency set. When you look at the sort of competencies of major corporates, they haven't been touched for 20 years, you know. It's a very different kind of person we need to be growing, and we need to be growing people according to their strengths rather than trying to make this perfect 360-degree human.
You mentioned a moment ago about how technology is going to play a role in this as well, and there is obviously a lot of talk about what companies are going to look like in 10 years, 20 years, when you have more and more technology involved, when the potential of AI is there, even more so than it is now, and how that is going to be a component, obviously, in where companies want to go in X amount of years. That's going to be another impact on the company and the structure and the people that are working there.
And I think there are some real myths about this that are quite dangerous. So, for example, this idea that AI is going to mean we're all working at, a 4-hour week or something like that. Actually, we've done a huge study called the Global Talent Crunch, again working with Korn Ferry, which looks at the fact that actually artificial intelligence is going to drive an enormous global skilled talent shortage. We're going to be about 78 million workers short by 2030. Yeah. And that's really going to hit our knowledge economy like financial services and technology. And it's going to wipe the equivalent of the GDP of Japan and Germany off the global economy every year. So what we really need to be focusing on with technology is how do we upskill and reskill our entire workforce? Because we don't have a talent shortage, we have a skilled talent shortage, and there's a big difference. And I think it's better for society as well as corporates if we start to address that now. And if we start to upskill people now, that would also give us the platforms that we need to be able to constantly upskill and reskill the whole workforce in order to keep us up with technology.
A lot of this is going to end up impacting, as you said, with investors, their decisions, their investment decisions moving forward. And it almost feels like, to a degree, we're looking at a kind of a new landscape for investing moving forward, correct?
I think the investment landscape at the moment, it feels that it is at a sort of a tipping point, an inflection point. And the way that capital is being allocated is very interesting. And this is something I would love to investigate further. But if you look at how difficult it is for an existing established traditional company to gain the finance it needs to pivot from the old world to the new, versus the relative ease of some, we might call them pre-profit or jam tomorrow or gingerbread companies, to raise finance when they've never made a profit, this is really interesting. And so is capital being allocated correctly? Obviously, our traditional old companies, they have no right to capital. So if we think there's no future, then capital should probably be reallocated. But at the moment, there seems to be a real sort of investors not favouring established companies and perhaps favouring any company that they think can be classified in the technology bracket. So you see some very interesting things with lots of companies racing to be classified as a technology company because, of course, that increases their valuations. But not all of these companies are actually that technology driven or that scalable. So it feels like a little bit of a gold rush at the moment. And some of the events of recent weeks on the stock market show us that actually perhaps we're seeing a bit of a market correction there and people are thinking twice about their investments.
It's funny when you think about companies that in kind of the technology sector that may fit in there, that still are struggling to find that profit. I'm thinking Uber right off the bat, and their structure, obviously, which is received so well by consumers at large. Yet here we are, 10 years into this company being a part of our culture, and yet they still are a company that is looking to find a way to be able to turn a profit. Elon Musk, the same way with Tesla as well.
And I think the question is, if these companies make it to the other side of the desert of no return and that these companies actually get that first mover advantage, will they be the last company standing and will they succeed in the end? Or is this a little bit like the emperor's new clothes? So it's been very interesting. I heard an interview with the CEO of Regis, and they asked him why WeWork's valuation was so much higher.
Sure.
And he said, well, they've got much better marketing than I have. And, that's optional. Obviously, he could invest in more marketing. But it is very interesting because WeWork is seen as a technology business, but actually that business model is extremely comparable to Regis. So I think we're living in very interesting times in terms of how companies are categorized.
What do you think this means for your firm moving forward?
This is really exciting for my firm because what we do for a living is we investigate these big ideas on behalf of our clients and develop visionary thinking. So what this means is that our clients need to be seen as navigators of this very uncertain world, because that's what you want from your technology firm, your accountant, your law firm. So that's very positive for us. But what it also means is that this uncertain world is throwing up some really exciting areas of investigation. How are people going to interface with technology in the future? What's the future of global trade? What does globalization look like? These are enormous questions. So in terms of man bites dog stories, it's all very exciting.
Nice meeting you, Claire. Thanks for joining us today.
Great to meet you.
Claire Mason, founder and CEO of Man Bites Dog, will continue with more of the Future Ready Organization Conference here in New York City in just a minute. You're listening to Knowledge at Wharton here on Sirius XM 132, Business Radio powered by the Wharton School.
A Business Radio Brief.
We're joined by Jack Welch and Susie Welch.
Leadership today, let's be clear, is so good compared to what it was in my time. People are much more engaged. People are more involved. The process is so much better.
I do think leaders also, there's a higher cultural value on leaders being authentic. People do bring more of their whole selves to work, but there's never enough of it.
It distills down to two words, truth and trust. You've got to get truth in your company, get rid of the spin and all that, and you'll only get that if people trust you.
Business Radio powered by the Wharton School.